Welcome to this Market Outlook webinar with Chris Reedy, our principal, Brian Fahey, Senior Investment Strategist, Rod Cohen, Senior Financial Advisor, and Brian Perry, our Executive Vice President and Chief Investment Officer.
We've gotten a lot of questions from a lot of different clients about a variety of different things over the last several months. And I think it all circles back to the fact that these are interesting times. And there's a lot going on and a lot of uncertainty. And when that happens, people naturally want to know how it's all going to turn out. And let's see if we can unpack a little bit of that by starting with asking a question around tariffs and really starting with what are tariffs and why do we care, right? I mean, we spent a lot of time in the last several months talking about tariffs. What are they? Why do they matter?
When it comes to tariffs, there's only three people or three parties that are involved. So tariff is just a tax on goods that are imported into the country. It's either going to be paid by the exporting firm through lower prices or lower profit margins on their sales. The importing firm can accept a lower profit margin and essentially pay for it that way. Or the consumer can pay a higher price and the tariff is just passed on to the consumer. Previous experience has suggested that in general, tariffs are going to be spread among those three parties. And then the aggregate effect of those tariffs historically has been more inflation and slower economic growth. As of last week, though, it's important to note that the International Trade Court decided against the Trump administration, their usage of the International Emergency Economic Power Act, which put the reciprocal tariffs that Trump enacted on Liberation Day basically on ice. That probably is going to wind its way into the Supreme Court. According to Bloomberg Legal, there's about a 60% chance that the Supreme Court upholds the lower court's decision. So that may or may not change. Kind of hard to say. I mean, when the tariffs were initially announced, nobody was really thinking it would go this far, at least the people that I read. So that certainly makes things a little bit more uncertain. There are other levers that the Trump administration could pull if they really want to enact tariffs. One actually went into effect this morning, which is the additional tariffs on steel. That's done under Section 232, which is where the Commerce Secretary does an investigation and finds that foreign goods are posing a national security threat. So that's being used to justify tariffs on steel and car parts. They're also currently reviewing threats from semiconductors, pharmaceuticals, coppers, lumber, and others are being proposed. So even though there's kind of a strike against Trump tariffs from last week's court decision, this isn't going away. There's still a lot of different things that the Trump administration could do to get tariffs into effect. The last little piece, in the budget bill, there's a section called Section 899, and that allows the U.S. to impose additional taxes on companies and investors from countries that it deems to have punitive tax policies. So that's a potential piece that might be coming down the road. We'll see how that winds its way through negotiations for the overall budget bill. But I think the bottom line is things are even more uncertain today than they were even a couple of weeks ago. And obviously, we've been dealing with a lot of uncertainty on where tariffs are going. Unfortunately, it doesn't look like it's going to end anytime soon.
Hey, Brian, it occurs to me that in a vacuum, people don't necessarily seem to care about tariffs, right? Like what is a tariff? It's a mechanism. I think they care about what tariffs cause, right? And if I look at that last bullet point you have there, that in aggregate, economists believe that inflation will increase and economic growth will slow because of tariffs. I think that's what scares people, right? It's the fact that, hey,
Yeah.
I'm going to be able to buy less and pay more for the stuff that I'm buying.
Yeah, I mean, think about where we were at the beginning of the year. Economists were expecting 2 to 2.5% GDP growth this year. Now that estimate's closer to 1. We'll have a job report on Friday. We were running at about 160 or so thousand jobs just a couple of months ago. The print that comes out on Friday is probably going to be around 100. So that's how tariffs are actually impacting the real economy. Companies don't want to fire people because they're worried about getting new labor, but they're also not excited about hiring people with all this uncertainty from tariffs because they're not sure how much they're going to have to pay for their imported goods. So that it hits you if you're a manufacturing company or if you're just a retail company.
Well, and it's interesting because, as you look at different types of firms seem to be approaching this differently, right? And it's interesting to me here that depending on if you're manufacturing or service, you might approach tariffs or what they mean to you in a different way, right?
Yeah, for sure. I mean, this is a good slide from Apollo, which is a group that I just subscribe to their information. But it's just interesting that if you total up those manufacturing survey results, it comes up to way more than 100%, which I think tells you that companies are going to try to pull every lever that they can to remain profitable. So yes, portion of that tariff increase is going to go to the consumer. Maybe it's going to be a little bit lower profit margins. Maybe it's companies deciding, hey, I used to do business with China, now I'm going to do business with somewhere else to get the inputs that I need to make my goods. But companies are going to do what they can to minimize the impact of tariffs. And if we've learned anything since COVID, it's the fact that American businesses are very dynamic and able to navigate really complex environments and produce results that are much better than what people anticipate. Companies have been doing that really amazingly well for 5 years now. And COVID was in a way a learning process for a lot of corporate America, where they figured out that they can diversify their supply chains and be a little bit more nimble than maybe they've been historically. Not to say that these changes aren't big changes that are going to cause some disruption, but wouldn't want to discount the ability of American businesses to be dynamic and make their way through this in a more profitable way than maybe what economists are expecting today.
Yeah, and I think that brings up a great point is that if this had happened, I don't know, half a dozen, 7, 8 years ago, it could have been more of a challenge, but we essentially have had a test run of how to resource goods and services, right? Or how to change supply chains thanks to COVID, where just a handful of years ago, we saw a world where, McDonald's was no longer able to have clients come to their establishment, right? And all of a sudden, DoorDash, which was already around, but now everybody DoorDashes, right? And so companies are pretty innovative when one source of revenue is taken away. There's a pretty strong motive to continue to make profits, and they're pretty good at finding new ways to continue to do that, at least in my experience.
Yeah, I mean, the US is a $30 trillion economy. So maybe there are certain aspects that are slowing down as a result of tariffs and the uncertainty that it brings. But that, to your point, that'll bring up the next DoorDash, whatever that is for tariffs, that area will fill the gap.
And can you give just a couple examples, just so we're all on the same page of what a manufacturing company is, and maybe a couple examples of a service company?
Yeah, so manufacturing company is going to be a company that makes anything you could touch. So it could be Apple, it could be General Motors, it could be a widget, the company that made your air conditioner. Service company is going to be anything you can't touch. So going to California this weekend, the service provider is Delta Airlines. That's a service that moving me and my wife to California is a service.
Okay. As we look at, so I'm not sure whether then a retailer would fall into manufacturing or service or somewhere in between. But it looks like they have, we look at two companies that are both dominant in the retail industry and maybe different strategies here as far as what they plan to do.
Yeah, and put this one in there because it did make some headlines a couple of weeks ago. But if you weren't paying attention to the financial news, which I totally understand, Walmart weighed some ways because they said that they're going to have to pass on the cost of tariffs to consumers. So for Walmart, and again, this kind of gets back to the idea that the US economy is incredibly dynamic. Walmart sources a lot of the goods that they sell from China. Their profit margins are incredibly narrow. So what you're looking at here is if Walmart sold $1 worth of goods, they're going to take, at the end of the day, they're going to have about 2.5 cents of actual profit. And if we look at Home Depot, if they sell $1 worth of stuff, they're going to have almost a dime worth of profit after everybody is paid. But for Walmart, if they're selling Chinese made goods and those goods are 30% more expensive, they don't really have a lot of wiggle room within their supply chain or within their business operations to absorb that cost. They're already an incredibly efficient company. So for them to find the savings, they can't. So what they're going to potentially have to do is increase prices. Somebody like Home Depot who's maybe selling lumber that was made or produced in Canada, maybe those tariffs aren't quite as impactful, or maybe just by the nature of home improvement stuff, maybe a lot of that is more domestically produced or not coming out of China, or maybe there's multiple providers for some of those different goods. They have said that they're not going to pass on much of the cost of tariffs to the consumer, but they also have much larger profit margins than Walmart has. So Again, I think this just points to the idea that a bulk one answer that tariffs are going to increase prices to all consumers probably isn't correct, because there's a wide range of different business models and businesses that we all work with that will be able to adjust how they bring those goods to market and do it in a way that doesn't necessarily increase prices as much as we may anticipate.
Well, let me ask kind of the elephant in the room then, which I would love to dance around, but it's sitting there in the corner, and I figure we should acknowledge it. Is you've touched on multiple things about tariffs that don't sound great, right? um, these companies are going to make less profits, right? Or they're going to pass cost along to consumers. So either if their profit margins go down, they're going to hire less or have to lay people off or whatnot. Or if they pass it along to consumers and inflation goes up, you mentioned economists think either the economy will slow down or inflation will be higher. Hearing a lot of negatives from these tariffs. So why right, what the heck is the strategy here? Why are we doing tariffs if we're listing off all these problems and issues and ways that we're gonna have to navigate? I haven't heard any of the benefits. What are the benefits or the hoped for proposed benefits of tariffs? Why are we doing this?
The long-term hope is that we will bring more jobs that have been offshored over the last 20 or so years back home. That will take time. It's not going to be painless, just like it wasn't painless when those jobs left. But that's the hope.
Okay. Odds of success, and we're going to hold you to this. How many jobs and by what date?
Not a lot.
Yeah.
Yeah, I mean, I think the
Go ahead.
fact that these are being challenged in court, I think, is probably a good thing, because it'll prevent overreach from the executive branch, right? We have three branches of government, and they all have a role. So you don't want one overreaching the others, because democracy is supposed to work like that, right? You have some give and some take, and we're just seeing that play out in real time. Democracy is messy, but you've never made money betting against the U.S. We always pull together, like Churchill says. After we've exhausted, Americans will come to the right decision after they exhaust all possible alternatives. Like we'll figure this out. We'll make it our way through, but it might be a little dicey in the intermediate term or the short term.
Yeah, that Churchill quote is one of my favorites, and it speaks to, I don't know how relevant economic statistics from, 1836 are, but this is a really, really long-term chart of tariff rates. And, throughout this period, as you think about the 19th century, the economy was obviously very different, but it was a period where the U.S. was ascending to become, one of the world's dominant economies, along with, probably at the time Germany and the UK, maybe a couple others, and then certainly in the post-World War II era, has become the world's dominant economy across various tariff levels. Although you see clearly that for the last, I don't know, the last 75 years or whatever it is, that tariffs have been on the decline. But it's interesting that America has been through a lot in the last 200 years. I mean, World War I, World War II, right? Great Depression, the Civil Wars in there, all these terrible things. The economy's done just fine across a variety of regimes, and I think that speaks to, whether it's democracy, whether it's the liberties we all enjoy, whether it's the power of capitalism and companies trying to make money. My son loves Jurassic Park, and there's a quote in there that says life will find a way. And I think there's like sort of profits and capitalism will find a way. And for better and for worse, it's not perfect, but companies and people in general are pretty good at finding a way to make money regardless of the external environment. And that will probably continue to be the case, I would suspect.
Yeah, that's never going to go away.
And even on this chart too, you see that in 2018, right? I mean, tariffs are not a new thing. Trump in the first administration brought them in, and that was maybe more of a surprise. And then even under Biden, there were still relatively high tariff levels. They just got a lot less headlines. And so we do have experience in the last decade with tariffs and enjoyed a pretty fruitful economy and a pretty good stock market, absent obviously some hiccups, despite tariffs and trade wars and this and that. So, certainly there's a path to success. It's just, to your point, will probably be bumpy, right?
Yeah, and bumpy, maybe that should be bumpy relative to where we thought we were at the beginning of the year. Because if you remember at the start of the year, the business community in particular was very excited about the prospect of potentially lower taxes, less regulation, a lot of the kind of just a more business friendly environment. Americans were as bullish on the stock market as they've ever been at the beginning of the year. So when you say a little bumpy, it's really relative to where we were 5 months ago. When you're coming off all-time highs of equity exposure and individual investors, and everybody thinking that things are going straight to the moon. But still, maybe the economy grows at, call it 1-ish%, 1.25% this year. That's not a recession. And in that environment, corporate profits can do pretty well, and you can actually get pretty decent returns in the equity market, even if the economy is not growing at the speed that we were coming out of COVID.
Yeah, I mean, and this chart is pretty instructive, right? The round trip that the S&P 500 has done so far this year. And, for those that are listening, I just want to point out that if you look at that sharp decline into April and then that really sharp rebound, I want to make it really clear that we were actually doing a webinar, myself and Joe Anderson, the CEO, the day that really sharp increase happened. And so I just want to make sure we get full credit for that rally that you see right there. And we more or less called the bottom about 5 minutes into our webinar, and since then it's been a pretty good ride. So you're all welcome. But why has the market rebounded aside from Joe and I speaking up at that moment? Why else has the S&P had this rally here in the last couple months?
Well, I think it's the initial shock from Liberation Day. The Liberation Day announcement on tariffs was substantially worse than what anybody was anticipating. And then for the most part, it's been rolled back either directly by Trump or indirectly by the courts. So what the market was initially reacting to when it fell so precipitously in early April was really reversed, either directly or indirectly. So I think the surprise of the initial response from the Trump administration caught a lot of people off guard, and investors responded by selling anything that wasn't nailed down in a hurry. And then cooler heads prevailed, and we're back to just under 6,000 at the moment. So not quite all-time highs, but not too far from it.
Well, and ultimately stocks are driven by earnings, right?
Yep.
I mean, I'm gonna be a little glib and say the rest is noise, but ultimately at the end of when you buy a stock, you're buying a share of a company, right? And it's pretty easy to get sucked into the market, but ultimately what you own is a share of a company and a share of their future profits, right? And talk about profits a little bit.
Yeah, and I think earnings are correlated to stock returns at like 80-ish, 90% when you look over a reasonable time frame. So if you look at a couple of years, it's really going to be the earnings that drive those returns, not the day-to-day noise or the political environment. It's just how much money can companies make, because I get a slice of that as a shareholder. So what we have here is two lines showing the forward or expected price to earnings. So this is what analysts anticipate companies are going to earn over the coming year, and then the price is divided by that. We have two lines because over the years we've talked a lot in our newsletters about the equal weighted S&P, which is just you take the 500 companies in the S&P 500 and you assign a weighting to them equally. That's the green line. The orange line is the market cap version of the S&P. So that's, again, another topic that we've talked a lot about in our newsletters over the years. It's just how top heavy the S&P is. So those Magnificent Seven that obviously we've talked a lot about, they're a pretty big chunk of the S&P because they are so large on a cap weighted basis. So what you can see is you're still paying a premium essentially to get access or a higher allocation to those quickly growing tech companies. But even though we've come through the silliness of tariffs and we're kind of somewhat resolving parts of that, analysts aren't thinking that we're going to see a real deep fall off in earnings. There's still a lot of optimism out there. And if earnings are what's driving long-term returns in the equity market, this is something that we pay attention to, but we don't need to overly focus on it.
Let's shift gears a little bit and talk about bonds. And stocks are popular and people watch CNBC to look at them, but the reality is the bond market is several times larger than the stock market. And I often compare it to like the nervous system or the plumbing, where when stock markets fall, people in economists get nervous, but when the bond market has seizures, which it periodically does, like in 2008, 2009, that's when you see things really seize up and you see real issues in the economy. And so looking at the 10-year Treasury bond yield over time, it's come up quite a bit in the last handful of years, which has resulted in pretty poor performance for bonds, although they continue to play a role of generating some income and providing some diversification during market sell-offs. One thing I like to point out all the time, and then Brian, I'd like your comments, but there's concern about rising interest rates, and a lot of times it's linked back to the U.S. National debt. And for everybody out there, I started my career in 1996, and I actually come from the bond market as a bond trader and then a bond portfolio manager. And I think since about a week after I started, people were worried about the national debt, and then 5 years later, 10 years later, and someday markets will be worried, but to date, they really haven't in the last 30 years. The other interesting thing to me is that although there's worry about interest rates at 4 or 5%, or what if they go to 6 or 7, if you look back to the 1990s, like forget the 1980s and stuff with double-digit interest rates, even in the 1990s, interest rates averaged like 7%. And the economy was really good in the 1990s. We had the dot-com boom. We had very low unemployment. We actually had a budget surplus for a period of time, despite those much higher interest rates. The reason I point that out is that the economy can thrive with moderate or moderately high interest rates. And so just because rates go from 3 to 4 or 4 to 5 or even 5 to 7 doesn't necessarily spell an economic recession or economic doom or anything like that. You can still have a really strong economy. I think if you got to 10 or 15% interest rates, you'd have an issue. But if you see, and this isn't a forecast, but if over the next 12 or 24 or 36 months you were to see interest rates move higher, I don't know that absolutely needs to be bad for the economy. And as investors, it just means you're getting more income from your existing bonds as well, which is kind of a nice thing.
Yeah, and I think there are good reasons for interest rates to be higher. Like interest rates are demand for money. So if you have a lot of people that want to start businesses or expand businesses and they need a loan to do it, interest rates are going to move up for good reasons because people want to borrow a lot of money to build new factories and hire new employees. So that there are good reasons for interest rates to come up. But one of the reasons why I put this chart in the deck is really to highlight, and it's not the noisy chart that we usually see. This is just on a quarterly basis, but just to highlight how different and unique the period between the great financial crisis and COVID really was. Because that was a period when we had really low growth, real economic growth, and really low rates. Had the Fed trying to do everything they could to stimulate the economy, and nothing really worked until we hit COVID. So I think the reason why this chart's in here is to show that our recent experience, call it 2009 through 2020, was the weird part. That's not the normal part. Rates are normalizing. We're getting back to the world as it looked prior to the financial crisis, where you do have real economic growth, you have real demand for credit, and banks are loaning funds in a way that we haven't really seen for, call it, the 15 years from the financial crisis to COVID. So having the 10-year right now, it's at about 4.3-ish, despite all the headlines about us going into, having issues with our treasury market. This is normal. This is actually a good sign that the economy is growing and that there's demand for credit. So I think having the 10-year around 4.5%, we shouldn't get worried about that. I mean, I remember when I started my career prior to the financial crisis, not quite as far back as Brian, but back then, anytime the 10-year dipped below 4, you would sell your bonds and buy equities. Because that was the line, the dividing line in the sand, where rates don't like to be much below 4. So if bond prices have gone up, then you sell your bonds to buy equities. But that's how it was, and I think we all forgot about that because the financial crisis had such lasting impacts and really had scars on the real economy for a long time. Kind of forgot that that's how it's supposed to work.
What about let's maybe just touch briefly on the consumer, because ultimately, what we all do, right, collectively, the individual choices hundreds of millions of us make is what drives the economy, right? And once you boil it down to microeconomics, so how's the consumer doing despite all the uncertainty?
Yeah, so 70% of our economy is just what you and I do. It's spending on a daily basis. And our ability to spend is largely dependent on having a job or not. So like I mentioned earlier, we do have a new jobs report coming out on Friday. It's probably going to be a little squishy, a little on the soft side, probably around 100,000 new jobs. But we have a pretty stable labor market. So you can see the change in payroll, it's certainly slowed from, the kind of the post-COVID employment boom that we went through, but it's stable. The unemployment rate, it might tick up one notch on Friday when we might go to 4.3, but it's been stable for quite a while now. And I remember back in the 90s, 4% was like the minimum unemployment rate. Like you couldn't go below that. It was like the 4%ers that just didn't want to get a job. And now we've kind of gotten used to something lower than that because there is so much demand for labor. But there's enough jobs around to be kind of in balance between job seekers and employers. The consumer is actually doing pretty well in terms of having real income. So after you're adjusting for inflation, real disposable income has been actually pretty strong for quite a while now. And that translates into consumers having the ability to spend on what they need to spend on. Actual spending is a pretty volatile number, especially with people maybe trying to front run tariffs and having maybe a little bit more auto purchases the last couple of months. But consumers are still spending, even if survey data is coming in saying that consumers think this is, as bad of a time as we've had since the financial crisis. Don't look at that. Look at what they're actually spending, and spending numbers. And we look at this on a regular basis on a high frequency dashboard that we have from Bloomberg. You're really not seeing slowdowns on anything. A little weak in lodging, but nothing to be worried about. Airline travel's fine. Restaurant reservations are fine. So you're not seeing any kind of real weakness within the consumer. Job market is stable and wages are growing at a healthy clip. So that does not point to any kind of recession or anything beyond like maybe a little bit of a slowdown in the economy, but still growing.
Well, you made such a great point there about focus on what's actually happening, right, rather than the news headlines. And it's such a valuable lesson that it's always so easy to get caught up in sensationalist headlines and this and that. But the truth is usually a lot more nuanced. And the economy is much more like an ocean tanker that's turned slowly for the most part, as and maybe COVID's an exception, but as opposed to something that moment to moment with the latest flashing headline on CNBC is actually moving the economy. It doesn't work like that.
And so many of those numbers that you'll see as a flashing headline on CNBC or whatever news source you go to, they usually truncate the chart to just show like the last couple of maybe years, so they can avoid showing the low impact, the effects of COVID, and maybe that particular line, whether it's consumer debt or whatever it might be, just has a really unusually low base, and they're showing the line going up steeply from there. And really, the way to look at it is, what did this number look like before COVID? Because COVID was weird. The years after COVID were just not normal. So if anytime you're looking at a chart online that just starts in like 20 or 22, it's because people don't want you to see what happened before that, because it doesn't make their point. So as the economy continues to normalize after all the random impacts of COVID, we're just getting back to normal in a lot of different areas.
Hold on, wait, Brian, are you saying that people sometimes use statistics to prove a point and they manipulate the statistics in a way to make their thesis sound better?
It's the dark arts.
I'm aghast and shocked at that. I wouldn't have thought it.
Yeah. Yep. It definitely happens.
So
Try to
with
avoid
that in
it, but
mind, and with the constant parade of stuff that we all get thrown at us, I'm trying to think of a polite word there to use. What should we do during these uncertain times, right? So let's talk big picture a little bit as far as what things look like. And let's maybe start with the fact that stock market declines or stock market volatility are part and parcel of the journey.
yeah, and this particular chart, it's a drawdown chart. So what you're looking at here is anytime that line is moved, that purple line is moving down, the stock market is that percent off of its all-time high. If this line is on the flat part near zero, it means it's either at or making a new high. So that's just how to read this chart. We stopped it specifically at negative 17.5 because this is the chart that Brian used when he did the webinar with Joe Anderson and caught the literal bottom of the equity market. Because I think it's recent enough that we can all remember how we felt on that day. If you're paying close attention to it, you probably felt pretty uneasy because the wheels were seemingly coming off the bus. But now we're back pretty darn close to being exactly where we were. Well, we're above where we were at that moment in time prior to Liberation Day, and not too far away from making all-time new highs. So it did include that in there, just as a little reminder to everyone that the market does bounce back, even when it's terrible. Because somebody I used to work with that a long time ago told me my job was to make sure that people understood that it's never as bad as you feel like it is, but it's also never as good as you think it is. And if you look at this chart over longer term, we go through those kind of corrections pretty periodically. Like this one's even better because it's showing you the in-a-year declines. So, if you pay attention to the market on a regular basis, you'll realize that things go up and down pretty quickly. But this chart just does a good job reminding you, hey, in, pick a year, 2015, the market ended the year down 1%, but you had a 12% decline over the course of that year. So having a decline of 5 to 10% during a year, it's table stakes. You're going to have that almost year in and year out with the S&P. Even over longer term, obviously the S&P has done quite well and it's up 80-ish% of the time, but it's not a straight steady ride.
So with that in mind, I think one of the things that this causes is people, not everybody, but some people have a tendency to want to move out of the market, right? And generally speaking, people don't move when the news is good and markets are going higher. They get nervous or they get grinded down when the market is falling sharply, right? That April period. And this is one of my favorite slides here, and it looks at the cost of timing the market. And obviously there's a lot going on in this chart. But when you look at it, it says, okay, what happens if you put $10,000 in the market? And this looks at a 20-year term from January of 2003 to December of 2022. And there's a reason why we picked this time frame. That the data would be the same if we moved it forward till today. But I like the fact that this slide also shows the 10 best days as well, which is why we use this one. But if you put the $10,000 in over the course of 2 decades, you wind up with about 65K, which is pretty darn good, right? That's the road to financial success. But if you missed just the 10 best days, so you missed one day on average every other year for 2 decades, your returns get cut in half. If you miss the 40 best days, you've now lost money. And if you miss the 60 best days, so on average you miss 3 days every year for 2 decades, you go from making money to where you have 65K to where you have $4,000. That's the difference between financial success and living on ramen noodles. And what's really instructive is when are the 10 best days. So if you look across the bottom here, you can see that most of the 10 best days were either in 2008, 2009, so that was the financial crisis, or during COVID in 2020. And if we ran this chart out further, it turns out that I think it was the second or third best day in market history was actually the day we did that webinar that we were talking about, where you saw the market fall 10 or 15% over the course of a week, a couple of really sharp declines, and then a really bad opening back in April. And then the market rallied and had one of its best days really in history. So the best days tend to occur during the darkest times, which is why it's so hard to time the market. With perfect foresight, of course, you'd get out when things are down and then get back in right before good times happen. But I've probably never met that person. Maybe someday I will. And I don't know about, Brian or Chris or whatever, if they've met, or Rod, if they've ever met the person with perfect timing, but I certainly haven't.
I was reading a research report by Michael Mambasini the other day, and he had a quote in there that said, "Don't try to buy at the bottom or sell at the top. It can't be done except by liars." You can't exactly time the market because you need to know, even if you had perfect foresight, you need to know the day before. And it's always the best days, volatility clusters, the best days are going to be right next to the worst days. And trying to time that is just impossible. You shouldn't even try because nobody can do it.
So what can you do in order to navigate uncertain times? And I think that one valuable tool is diversification. And so maybe comment a little bit on that.
Yeah, so we certainly can't control the market, but we control our exposure to the market. So this slide is just to kind of give a visual demonstration of how we manage money. We're not necessarily we're never going to exit equity markets, but we can change our exposure to those equity markets. So do we want to have more growth or do we want to have more value? Growth typically does better, or at least has done better over the last handful of years, but it also experiences pretty significant drawdowns. So how much exposure to that do you want? You do have potentially more upside, but that comes with more downside. You want to have more kind of big stable companies like mega cap value fund that we use from Vanguard. Those are kind of boring companies, but they're nice and stable, and they're not going to be buffeted the same way that other companies can. And same thing on bonds. for years, we've been underweight duration, and duration is just a fancy word for your sensitivity to changes in interest rates. When the economy is going fine, you don't want a lot of interest rate risk, or if you're dealing with inflation like we have for the last handful of years, that's just a risk you don't want. So we can adjust our allocation to try to smooth out the ride. Like I said, we can't time the market perfectly, but we can change our exposure to those risk factors within the market, whether that's on the equity side, the bond side, and then we can diversify across regions and different sectors within the economy to try to smooth things out, forecast the best we can. But we can never perfectly forecast things, so we're just going to try to smooth the ride, but not get off the ride.
Cool, thank you. That's a fair amount on sort of tariffs, the economy, markets, and how to navigate them. And we're happy to take any questions that you have on that. But before we do, I want to kick it over to Chris and Rod. As you all know, we came together a couple months ago and couldn't be more happy with it. We look for really the best firms in the country, right? It's like who's out there that we truly think can bring in talent and bring in a culture that can take Pure Financial just even further than we've gone. And we don't find those people very often. And, as we came across Chris and Brian and Rod and the whole team over, it was just like, wow, these are great people with a great culture, with great services, really smart. And these are the kind of people we want to partner with to help serve more and more clients and really help people meet their financial goals and continue the mission. And so we're really, really happy and excited about it, and wanted to kick it over to Chris and Rod to answer any questions around how things are going. So let me kick it over to Chris.
Over the last few weeks, we've received expressions of interest from our clients, just kind of wanting to know how things are going since the transition. So we thought we'd put in just one slide here, and I'll walk through a couple of bullet points. And let me start with just sort of a brief history lesson. All of our clients, or many of our clients, are aware that we started down the path of looking to the market for a potential partner in very late 2023. And we spent almost all of 2024 interviewing and getting to know several firms throughout the country and patiently performed technical due diligence, but it was as much about trying to find a match culturally and in terms of people and in terms of services. And so as a result, we determined ultimately that Pure Financial Advisors was the right fit for us. Still, you never really know until you're in the system whether or not you've made the right decision. And now that we've been in the system for a while, and several of my clients have asked, how things are going so far, we wanted to take a moment and talk about this. And so I've organized it into three categories: people, culture, and services. So let me talk first about people. It is accurate to say, and my colleagues would agree, Brian and Rod and others, that we haven't come across a single person yet within the Pure system who we didn't find to be really smart, really nice, really supportive, really cooperative, really professional, and just exceptionally good at what they do, whatever it is that they do. And they've all made us feel extremely welcome. And when we've needed help on things integration-wise or learning new systems, everyone is at the ready to be supportive, and we couldn't be more pleased with that. When I think about corporate culture, certainly people play a role there, but culture is about a little bit more than that. I mean, to me, culture is about sort of what is the personality of a firm on a day-to-day basis. What does the firm stand for? What are its values? Sort of how it's all generally oriented. And now that we've been within the Pure system for a while, I think of culture and I sort of try to find a descriptor or two to relay my observations about this. But I think I would say that we find Pure to be a culture of mutual cooperation and overarching service, whereby everybody involved in this, including us now, really feel a call to service that applies to the way that we relate to one another, and the fact that everybody's collective efforts are all focused on delivering the best client service that we possibly can. And in that way, and this is a really important point, in that way, Pure is feels to me like an extension of what we were at PIM. What we would have turned into had we chosen to stay on our own and given it 10 or 20 more years of growth. Cultural alignment is extraordinarily important. So wanted to take a moment and mention that. And the last point on my slide has to do with services. And let me share a little about why that's important. Prior to coming together with Pure, we had gotten to a point with personal investment management where the administrative responsibilities of running the firm were starting to be kind of onerous and almost oppressive and extremely time consuming. Things like compliance, HR, bookkeeping and accounting, cybersecurity, among others. And so when we were looking for a partner, one of the things we were looking for is whether or not they had the capacity to integrate us in a way where we could feel that all of these tasks would be expertly performed by our new partner. And we could lift those responsibilities and those time-consuming day-to-day business operations tasks out of our environment. And Pure has been a perfect fit for that. Compliance department, client services department, financial planning department, tax department. We are now sort of going through the initial integration piece, but we're already at a point where joining Pure allows us a great deal more time on a day-to-day basis to serve our clients, which is really what the end goal was and what we were trying to achieve. Aside from sort of HR compliance, IT, customer service, I mentioned briefly a moment ago that Pure has financial planning team and a tax team, and those are run by experts in their respective subject matter areas. And whether or not the financial planning team or the tax team ends up being relevant to every single PIM client will depend on the circumstances. But in the past, particularly with tax, if our clients brought to us a tax question, we were a little bit between a rock and a hard place, because one of two things would happen. We'd either know the answer to the question, but be unable to answer it because we're not CPAs. And there's a very fine compliance line in the sand that you just can't step over, or we didn't know the answer. And either way, we would have to suggest to our clients that they refer back to their tax professional. But what if they didn't have a tax professional? Now nobody knows and nobody knows where to go. Well, within the Pure environment, we have a tax team run by an experienced attorney who is an absolute expert at this stuff. So just sort of one example of additional resources whereby not only do we now have more time to better serve our clients because most of the administrative stuff is out of the office, we have access to additional resources beyond what we had in the past. So, in summary, I guess I'd say that our transition into Pure for our clients who are interested in how this has gone has actually exceeded expectations in every way. The people are great, the culture is great. We have more time now and we have more resources than we've ever had. Now, there may be some who take in my comments and think that it sounds like a little bit of a sales pitch. So let me share one sort of offsetting. I won't even call it a downside, but just so that I'm telling the truth. I'll speak for myself, and I might be able to speak for Rod as well. There are those of us around here who are not huge fans of technology, and when you join a new firm and you have to learn new business processes and new technology, it's not a whole bunch of fun. So all of the clients that I personally serve who have asked about how things are going, my answer is it's 95% exceeded my expectations, and I've got 5% to go, and that 5% is I still need to become more competent with new systems and new technology. For the younger folks like Brian and Jen and others in my office that our clients know well, they're like far ahead of the learning curve and they're probably already fully competent while Rod and I sort of lag behind. But yeah, so those are my comments on how the transition is going, and I guess we'll pass it back to Brian Perry or open it up for questions.
Well, let me thank you, Chris, and let me just throw it over to Rod and get his thoughts on it as well. And please be honest too. And technology.
Yeah. Yeah. Yeah, I'll basically bring that around to say that Chris and I are the old dogs that are learning new tricks. Um, yeah, literally, I can't, add anything. Chris did a great job of reviewing, the enhancements that we get with Pure. Probably the biggest piece, and I completely agree with Chris on this, is the simple fact of more time to do client work rather than the administrative parts of being a part of the ownership group. So, that's probably the biggest enhancement that I'm seeing, with my clients, and certainly the bench strength that Pure brings to the table, with regard to back office of help and assistance, and the tax expertise, the planning, the investments that where, in certain circumstances, there are investments that we did not use regularly that are now a part of the portfolio if we need to use those for those particular clients. But yeah, other than that, I exactly agree with Chris and the 95%, 5%, and he and I will continue to
We'll work towards 100%.
learn our new tricks.
Well, no, then thank you both. And yeah, I mean, I would echo one thing that was said of that exceeding expectations is that, we never would have pursued this path if we didn't have high expectations that it would be a wonderful partnership. But I would say that, certainly speaking for myself as well as the rest of the executive team, it certainly exceeded our expectations. The level of client service and client detail and care for clients was sort of table stakes for us, and has been met and exceeded. But it's also just the people and the culture and the desire to do right by clients has just been phenomenal. And so really excited for what's come so far, and what we're going to continue to see develop as we serve all of you and all of our clients across the organization. Let's see. I know, Catherine, I believe that we had a couple questions. If you want to toss those out to the group.
Hey there. Technical difficulties. First of all, we are so excited to just have everybody here. We are really we love the growth and everything that you guys said. And I'm one of the old dogs too, so I totally understand about the, all the new tricks. But just a couple questions before we let you go. Where do you think stocks are going to be? What do you think they're going to be doing in the rest of the year? I guess that's to you, Brian.
Yeah, hopefully that's to Brian Fahey, because I'm going to pass.
I guess that would be Brian Fahey then.
I think there's been obviously a ton of uncertainty over the course of this year, but one of the things that you can kind of count on, and there's signs of this in the economy, is there's a heck of a lot of enthusiasm around AI, and that's spurring a lot of business and investment. So if you believe some of the economic reports, 1% of GDP growth is directly attributable to AI build-out. So whether that's data centers or just investment in AI in general, that's a pretty big tailwind on a $30 trillion economy. You saw NVIDIA post earnings last week. They did have to take a pretty hefty write-down due to tariffs for some chips that were destined for China that can't go there anymore. But they still beat earnings expectations, and they're pretty bullish about what they're seeing in terms of demand. So I think we'll still see the equity market move higher. It's not going to go in a straight line, but we do have a decent amount of momentum, and there is an incredible amount of new investment going into new technologies that hopefully will make the economy a little bit more productive, a little bit more efficient. And I still hold out that the S&P will end up higher than we are today.
All right, you all heard it here. Brian Fahey guaranteed spectacular profits.
Don't use the G word, Brian. Just one thing about the merger. This is kind of back office stuff, but traditionally trading had been handled by myself and Sejenya. Now that we're part of Pure, we have a trading team of 7. So over the next coming months, you're going to see a little bit more enhanced cash management from us. So we wanted to do this for years. We just didn't really have the bandwidth to do it, to make sure that distributions would go out on time and we could still earn interest for client accounts that had cash set aside for distributions. We're going to be able to do that moving forward. You know, it's not going to change anybody's life, but just a lot of little incremental improvements in terms of how we manage assets, I think is a positive. A lot of good investing is just doing the basics really well. So I think having a bigger trading team for our assets or our accounts will improve the ultimate outcome. So we can just be a little bit more efficient in a handful of areas, which I think will improve the result for everyone.
Great. Okay, how about what happens if there is a recession?
Yeah, I mean, maybe I'll take a quick stab at that and then let Brian F. take it. You know, first of all, recessions are normal. They happen. They're part of the economic cycle. If you look, they periodically occur. So it's going to happen at some point, just like it'll rain at some point, sort of thing. You just don't know when. What's really key to remember is that recessions don't mean that the economy comes to a complete halt and that nothing happens. Again, absent maybe COVID with a global pandemic. So the average recession, the economy drops by about 1.5%. Right? I think there's a perception that COVID was obviously very sharp because of what happened, right? And the financial crisis was sharper than usual, but the average recession is about 1.5%. So, you know, if you think about it, you know, if you make $100,000 a year, maybe you make $100 less a paycheck or something like that. Or, you know, if you stay in hotels 3 nights, 3 weeks a year, maybe you stay 20 days instead of 21 days. Or, you know, if you go out to eat a couple times a week, maybe 1 week you go out once, but that's 1 week out of the whole year, right? The other 49 weeks or 50 weeks, you still go out twice. And so recessions, the slowdown is actually quite marginal for the average person. They're not proportional. So some sectors or industries or parts of the country might be hit a little harder. And obviously, if somebody loses their job, that's where the real impact comes. But a lot of recessions is more psychological in that you get a barrage of news, and you know, depending on your preferred news outlet, the news might generally be negative to begin with, and then you throw in a recession and you get hammered with it all day long, and it can feel like a lot of times things are worse than they actually are, and then all of a sudden you walk into a restaurant and they tell you it's a 45-minute wait for a table, and you realize, oh wow, you know, not everybody's in a bunker hunkering down, like people are still living their lives. That's a typical recession and what typically happens. But let me invite the other Brian to weigh in on that as well, or Chris and Rod, because you guys have being old dogs. Now that you're self-describing that, you've guided clients through multiple recessions, and so you know you've had the experience, right? Maybe talk on that of what it's been like to guide clients through recessions.
Well, let me just clarify what the questioner may have been implying, or the answer they were seeking. Can you talk a little bit about the relationship between a slowdown in GDP that might be defined as a recession and the stock market?
So the stock market is going to try to front run what it thinks the real economy is going to do. So if you have a recession, the stock market's going to front run that probably 6 to 9 months before it actually happens. It also tends to bottom before the worst news has actually happened. So if you're trying to make a change to your allocation or your portfolio and you wait for the bad news to come, it's too late. You should actually be buying at that point, not selling. With our allocations, we have reduced risk. We did that back in March with the Schwab allocations, the TIA and the Fidelity. We just marginally reduced risk by decreasing our exposure to those more volatile growth companies. And we did extend duration just a little bit. So we're a little bit more sensitive to interest rate changes than we were at the beginning of the year. Unfortunately, that hasn't been a great call. But quite honestly, the idea of us having a recession in the short term, it's just not going to happen. We've got 6-ish% federal budget deficit. You can't have a recession when you have Uncle Sam simulating the economy like that. So I think to the extent anybody's nervous about a recession in the near term, honestly, don't be. So, you know, we have reduced risk a little bit just because we think maybe the economy is going to be slower than it was at the beginning of the year. But the idea of having a recession this year, and you know that's still a pretty lengthy time frame in economic terms, I just don't think that's possible. So I think we'll be fine, and we are a little marginally less risky than we were at the start of the year. If you do run into a full recession, then you try to buy you have to front run it, so you have to anticipate that that weakness, and there's just no reason to anticipate that right now.
So maybe the key takeaway is that the market serves as a leading indicator for recession, and also maybe to sort of bookend this, you often don't know that you've been in a recession until after it's over, or at least you're some distance into it. Is that about right?
Yeah.
Okay, we have one more I think we can get to. With the uneasiness in the world, where or what is the safe haven for investments if bonds are in question?
It's still bonds.
Yeah, I don't think bonds are in question. I think, again, getting back to headlines versus reality, I think certain media outlets would like to make it sound like people are questioning the treasuries and that they're not a safe haven. I don't think the facts measure up to that. I think treasuries are still a safe haven. And then, obviously some people like gold or crypto, but I think high quality bonds are the main safe haven.
What do you think about international markets?
That is a really great question, to be honest. I've been doing this for 20 years, and really since the financial crisis, every year, when everybody's doing their year ahead outlooks, Europe is always one of the investment option of the new year. And it's been that way as long as I've been doing this. And I think maybe that's been correct like twice of the last 20 years. Well, foreign assets are doing pretty well, especially in dollar terms, because the dollar's off about 8-9% year to date. So that's a tailwind to returns. The other piece of it is foreign equity markets were priced somewhere along the lines that they were going to see a recession this year, or at least a slowdown more pronounced than what we have. And that's not happening. And those economies are actually doing better than expected. So you've got kind of two tailwinds for foreign assets this year. Over longer periods of time, if we start thinking about what happens in 26 or 27, the US economy is still the most dynamic place on the planet. Yeah, we're trying to shift our course on the margins here and there with certain policies, but we still start far more new businesses than anybody else on the planet. Maybe dating himself, but it's kind of like East and West Berlin. The US is still West Berlin. We're still developing a really aggressive economy that can come up with new ideas and market them, turn into a business and have a product much faster than anybody else can. The US economy is just going to be more dynamic than Europe. Europe still has a lot of issues. It's still, 28, 30 different countries that need to come together under the EU kind of umbrella. And that's a slow process. There's a lot of regulation. There's a lot of labor protections. It's just a different way of doing business, but it's grows slower. And that typically means you have lower equity returns. Nothing wrong with it. That's just the reality of it. So yeah, I think Europe and probably foreign assets can probably end the year higher in percentage gains than what we will do this year. Not to say that the US is going to end up down, but I just don't think that's a long-term answer.
Hey, can I take just a moment? I wanted to
Yes.
circle back to the prior question and provide some context for Brian and Brian. I did speak with somebody who had a similar observation to share and similar concerns somewhat recently, that it seems like some of the headlines, there's a bit of what might be reasonably assessed as sort of fear mongering over the state of the domestic bond market, like it's on the verge of utter collapse. And this might be policy, this might be economics, it might be a combination. And Brian, the stuff that you read every day is probably not those kinds of headlines. But to the extent that you're aware of that, can you sort of ease any concerns somebody might have?
There's a couple of narratives out there that just aren't right. One of them is that foreign buyers are just not buying treasuries anymore. So the idea that Japanese investors or Chinese investors or foreign central bank treasury managers just are not buying treasuries, categorically incorrect. It's called tick data. You can see who's buying US treasuries either at auction, and you're not seeing any change in foreign buyers of US treasuries. In fact, it actually ticked up. So I remember seeing a lot of news stories like, oh, China and Japan are selling all these treasuries. And then the data came out a few weeks later and the opposite was true. They're buying more. So, that's a narrative that's kind of popular, but it's just factually incorrect. We can literally point to data that says that that's incorrect. And still, the U.S. Treasury is still the deepest, most liquid, safe asset on the planet. So to the extent that you don't like treasuries because you don't like, something about America, what are you going to replace it with? If you're a big institutional manager, you're a central bank treasury manager, you don't really have an option. You can buy a little bit of gold. You can buy some Euro bonds or European bonds, but none of those markets are big enough or deep enough for you to actually move large sums of money. Even if you don't like it, you're stuck with treasuries. The other aspect is, obviously, having Moody's downgrade U.S. debt a couple of weeks ago made some headlines. They're the last major ratings agency to lower U.S. debt from AAA and on down, depending on what rating system they're using. But it's going to come to a surprise to no one that the U.S. has been running large budget deficits for a long time, and they don't really show any signs of changing that. But we have plenty of capability to increase tax rates. You just need politicians to say, okay, well, enough is enough. We need to bring in a little bit more revenue. So there is plenty of negative headlines on the bond market, but the 10-year treasury is at 4.35. If things are blowing up, that number would be 5.5 or 6. And it's been moving down in recent weeks.
Thanks.
There was an initial reaction when Liberation Day happened, on April 1st. People got nervous. They bought treasuries, which is the standard thing you do. And then treasury rates moved up, or yields moved up. And now we're kind of back, tracing that move back. So we're getting back into the low fours in terms of yield. Totally normal. I think longer term, having the 10-year somewhere around 4 to 4.5% is kind of what we should expect. Maybe it goes a little bit lower if we get more economic weakness than what we're anticipating, but maybe it goes to 3.8. So really, you can't have a lot of money leaving treasuries if there's nowhere for it to go.
All right. Well, gentlemen, thank you so much for all of your expertise and all of your information. We appreciate it.
Thank you, Catherine.
Thank you.